Hi, welcome back to New Zealand Property Insights. I'm Paul Roberts.
And I'm Debbie Roberts. We're the owners of Property Apprentice. And as always, we're here to help you cut through the noise and navigate the New Zealand property market with real facts, not just scary headlines.
Today, we're cracking open episode 17 with some of the most exciting shifts we've seen in months. While the mainstream media is busy painting a picture of a frozen property market behind the scenes, New Zealand banks are quietly relaxing the rules, offering cash contributions and actively competing to win your business.
Absolutely. So we're going to discuss why banks are easing their criteria and exactly how savvy buyers can capitalize on this before the rest of the country wakes up.
Plus, we're diving into a winter rental market, high stock levels and stark 18.6% correction in a major southern region are completely changing the game for some tenants and providing a brilliant playbook for some landlords looking to optimize their yields.
And to wrap things up, we're analysing the density debate. With the government backing down on Auckland's housing intensification legislation, we'll look at the rising popularity of apartment living, innovative local housing schemes, and the hidden costs you need to watch out for.
This episode is packed with positive, strategic insights to help you get ahead. So let's get straight into the data.
So first up, the lender appetite paradox, friendly banks versus hesitant buyers. We're kicking off our first segment with the latest figures from mortgages.co.nz and Tony Alexander Mortgage Advisors Survey, which aggregates feedback from 59 advisors across the country. The data reveals a dramatic turnaround. Banks are actively relaxing their credit criteria and competing for business, but buyers remain highly reluctant to commit.
This is a classic supply and demand mismatch in the credit space. While banks have opened their doors wide, buyers are standing on the brink of taking action, seemingly worried into inaction by short-term trends and global tensions. So let's lay out the exact facts. The proportion of mortgage advisors reporting an increased lender willingness to advance funds jumped 29% in June. That's a substantial recovery from near zero levels recorded over previous 2 months. With credit easing and translated into strengthened bank cashback offers, a high willingness to approve high LVR loans under a 20% deposit, lower uncommitted monthly income thresholds, and revised lenient treatment of non-standard income sources like maternity leave.
Advisors report that these criteria improvements carry no negative trade-offs or impacts for borrowers, and refinancing inquiries have rebounded to a net positive 12% from a negative 7% the previous month, driven almost entirely by borrowers chasing attractive cashback incentives rather than an organic lift in market activity.
Despite accommodating bank policies, first home buyers demand remained soft, with a 14% of advisors reporting fewer first home buyers in June, a complete reversal from February when a net positive 33% saw activity of first home buyers. However, it is winter, which generally reduces the market activity, plus it's an election year, which also tends to slow the market a bit. Survey commentary highlights that buyers are frequently pre-approved and financially ready to purchase, but are failing to commit, potentially due to the fear of locking in higher interest rates, even though interest rates are still currently below the long-term average.
This buyer hesitation has a direct policy anchor. The Reserve Bank of New Zealand, RBNZ, expects to potentially lift the OCR before the end of this year, forecasting domestic inflation to peak at 4.3% in the September quarter. Investor appetite remains weak, but has recovered slightly from April's low point of a net negative 49% to sit at a net negative 29% in June. So maybe investors are starting to realise that this is actually a pretty good market for house hunting.
Absolutely. Active investors are highly selective, focusing on proving yields through renovations or adding dwellers to existing properties rather than acquiring new standalone assets. Owner-occupiers are playing defensively, with over 74% of borrowers favouring a 2-year fixed term. Interest in shorter term has collapsed, and only 6% of borrowers are choosing a 3-year fix.
Standard advertised interest rates, excluding special bank pricing, sit with the 2-year rate at 5.69%, the 1-year rate at 5.26% and the 5-year rate at 6.24%.
When you look at the economic data, it appears to show that bank behavior is heavily dictated by their own internal business pressures rather than the actual property market health. The Tony Alexander survey notes that banks are intensely aware that they will struggle to hit their lending targets this year due to economic shockwaves and geopolitical tensions from the Middle East. Banks make their money selling debt right now. They have money that they need to shift, so they're cutting the criteria to win that market share.
First-time buyers, this is a classic analysis paralysis. They're watching standard 2-year fixed rates sit at 5.69% and waiting for rates to fall again before buying, instead of buying now and locking in below average interest rates to carry them through the rising interest rate environment. But as we coach our clients, recognizing windows of opportunity is how you find the good deals. Meanwhile, banks are willing to lend. That should be a good indication to you that they're confident in the future of the housing market. When rates start falling again, buyers are likely to flood back into the market, increasing competition and causing house prices to rise again, which will erase any benefit of a lower interest rate in the future.
I completely agree. Right now, because the sales market is quiet, you have potentially got good negotiating power with some vendors, and banks are willing to pay cash incentives and friendly criteria to win your business. This is a buying sweet spot.
Exactly. And looking at the fact that 74% of borrowers are locking in for 2 years, that shows that the market is collectively hedging its bets. They want flexibility, avoiding the volatile short-term rates, but refusing to tie themselves into a higher 5-year rate at 6.24%. The question is 2 years going to be long enough?
So segment 2, the winter rental glut, rising stock and Otago's sharp rent correction. So our second topic, we're diving into the rental market, which has entered an incredibly unique winter phase. Typically, winter brings quiet leasing activity, stable pricing, but current listings have surged to multi-year highs.
This is a rare window of high supply. For tenants, it means plenty of choices and a dramatic reduction in competition compared to the frantic summer months. But for landlords, it highlights some major regional supply shocks that require immediate strategic adjustment. So let's look directly at the facts. Realestate.co.nz data shows that 8,220 residential properties were available for rent across New Zealand at the end of May. That's the highest volume of vacant stock recorded so far this year.
This total stock available is down by a minor 3.4% compared to exceptionally high levels May last year, but overall supply remains highly elevated. The pipeline of incoming rental supply is historically high, over 7,000 new listings flooded the website in this year in May, matching the high volume of May last year.
In comparison, May new rental listings were under 6,000 in May 2024 and under 5,000 in May 2023 and 2022. This high listing volume has caused average national asking rents to ease slightly, dropping from a peak of $634 a week in January to $630 a week in May.
While most regions experienced only modest, flat or seasonal rent movements, the Otago region bucked the trend completely with a significant correction. The average rent in Otago plummeted to $569 a week in May, down from $699 a week in May last year, representing about an 18.6% annual decline. That Otago figure of an 18.6% drop in average asking rent in a single year is interesting. It shows what happens when local supply completely outpaces demand.
It's also a wake-up call for investors. As any experienced property investor knows, vacancy is the ultimate cash flow killer. If your property sits empty for a month because you're holding out for a peak rent of $699, for example, that vacancy could cost you nearly $2,800 in lost cash flow. Dropping your rent to the current market rent immediately to secure a stable tenant is likely to be a far smarter business decision.
Absolutely. If you have a rental property coming up for renewal this winter, you need to be hyper aware of the local competition and potentially offer incentives to keep a great long-term tenant.
Having a high supply winter shows why you need to have strong cash flow across your portfolio. You have to stress test your numbers against higher interest rates and allow for vacancies while still being realistic with your market rent expectations during re-tenanting. So the next segment, the density debate, Auckland's intensification backdown and the rise of apartment living. Our final segment today, we're going to pivot to Auckland's planning and density. In February, Resource Management Minister Chris Bishop announced changes to the Auckland's housing intensification legislation. This decision sparked a highly active discussion about how New Zealand's largest city should grow.
It's a polarizing debate. Advocates for housing density warn that scaling back intensification rules makes it harder to fix our structural housing shortages. Meanwhile, local opponents argue that it protects established neighbourhoods from overdevelopment. So let's look at the facts. In February 2026, Resource Management Minister Chris Bishop confirmed regulatory shift allowing Auckland to opt out of certain blanket housing intensification mandates. Commenting the decision, Auckland Mayor Wayne Brown joked that it would calm worried tenants in traditional high-value suburbs like Epsom, remarking 10 points to NIMBY House.
Yeah, so not in my backyard. All those homeowners that were like, no, not next door. Historically, New Zealand has had a limited apartment culture, with urban density historically confined to smaller blocks of flats and rarer architectural standouts like Park Mews and Hataitai or older state housing blocks. The transition towards high-density living accelerated in the 1990s when developers began converting commercial buildings, including Wellington's Old Dominion newspaper offices, Queen's Wharf and Aotea Quay buildings, into apartments.
Public sentiment is actively shifting, with case studies highlighting young couples achieving complete mortgage-free status by choosing apartment living over traditional quarter-acre house, and a 73-year-old retiree choosing to sell their family home and rent an apartment to preserve cash flow for travel. Other inner-city resident celebrated converting a commercial office suite into a home because it reduced their daily commute to under 10 seconds.
Nice. Local councils are actively testing new models. Wellington City Council runs the Te Kaianga program, partnering with private building owners to turn underused commercialised... One more try. Local councils are actively testing new models. Wellington City Council runs the Te Kaianga program, partnering with private building owners to turn underused commercial office spaces into high-quality, long-term residential rental properties. Private developers are betting heavily on this cultural shift, with firms like Ockham Residential delivering specialised high-density builds such as the Nix in Grey Lynn and the Greenhouse in Ponsonby.
Operational and financial variables of the apartment ownership include ongoing, often escalating body corporate fees, compliance with strict structural bylaws, and limiting control over adjacent tenants. The apparent relaxation of the intensification highlights the tension between local infrastructure limits and our long-term housing needs. If councils stop blanket density in established suburbs, it doesn't make the demand go away. It just shifts it somewhere else. But from what I love about this data is seeing how everyday Kiwis are taking control of their own financial freedom. That story of the young couple becoming completely mortgage-free sooner simply by rejecting the old quarter-acre backyard dream is proof that shifting your housing expectations can buy years of your life back.
Especially when people don't often have times to maintain those quarter-acre dreams anymore. But it is a good example. People are realising that traditional home ownership can sometimes feel like a financial anchor, whether it's the young couple saving decades of mortgage payments or the 73-year-old retiree freeing up capital to travel. Lifestyle flexibility is becoming the new gold standard. It's also great to see initiative in the rental sector. Wellington's Te Kaianga program, turning empty office blocks into secure rentals, is potentially a great way to repurpose supply without breaking ground on new greenfield land.
I agree, but investors and buyers need to go into this with their eyes wide open. Buying into an apartment complex is fundamentally different from buying standalone houses. You have to analyze the body corporate financials, minutes, understand the maintenance, sinking fund, read the bylaws carefully. And if you buy a building with a poorly managed body corporate, escalating fees can eat your yield alive.
And that's the critical risk factor. It reinforces why we always tell our clients to focus on the long-term fundamentals and run a proper due diligence process. If you want to leverage density for wealth creation, you can't rely on guesswork. You need to establish absolute buying parameters, stress test the body corporate fees, and make sure that the property strictly aligns with your broader financial plan.
So that wraps up episode 17 of the New Zealand Property Insights. While shifting housing regulations and local density debates might feel uncertain, this changing cycle is presenting some of the cleanest, most strategic buying windows we have seen in years, but only if you have the courage to act while others are frozen.
Exactly. When the crowd is hesitant, that's your ultimate cue to step up. If you want to learn how to navigate these local planning shifts, secure the best remaining bank deals, and evaluate apartment and density opportunities safely, we're ready to show you how.
We're hosting brand new, completely free online masterclass called How to Succeed with Property Investing. It's highly practical, 100% data-backed session designed to show you how to establish your buying boundaries, protect your cash flow from rising costs, and make smart moves when rules are shifting.
There's absolutely no sales pressure and zero obligation because our company doesn't sell property. We focus entirely on your education and strategy. I mean, if you want to become a client, that's fine with us as well. But you can find the registration link for the free event directly in our show notes, or simply visit propertyapprentice.co.nz to secure your free spot today.
Thanks for tuning in. Stay positive and strategic, and let's help build your financial freedom.
Happy investing, everyone. Thanks for listening. Hey there. Want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.